A few years ago, I spent over $5,000 on a professional level trading course. So if you're somebody who's thinking about spending their hard-earned money on something like this, give me a few minutes to share my honest review before you make the jump. There will be no gatekeeping. I'm showing you everything they taught me in the course, my top 3 takeaways, and obviously the most important piece you care about, how much I made, which I checked last night and it honestly surprised me. So let's go. So let's start with an overview of what I actually bought. There were 3 pieces to this entire trading course. The first course that I bought was around something called volatility. The second one was the actual trading course itself, beginning to end. And then the third one was using options to kind of supercharge this entire thing. Now, out of respect for this business and without giving away any of their proprietary materials, I'm gonna walk through each one of these so you can see what I learned and maybe you can make a decision on if this is something that you would even wanna do or not, or maybe it's overwhelming. And ultimately, I want you to be on the same page as me, so I'm going to show you how comprehensive this thing actually was. Try to condense the, 30 or 40 hour trainings that it was into like 10 to 15 minutes. And by the way, I should mention this video is not sponsored. That's why I'm not mentioning the company in here. If you're curious about what company I actually took this trading course from, DM me on Instagram. I'll link that in the description below if you're genuinely curious. Okay, so let's get into the very first part, which talked about volatility. Now, there were 2 main pieces to this. The first piece discussed something called realized volatility. I'm having a hard time spelling that. The second piece talked about implied volatility. Now, realized volatility, very simply, is just how much a stock has moved up and down over time. That's about as simple as I can make it. So if you have a stock chart that looks like this and it moves up 10% and down 10% over time, that would be the realized volatility. It's something that has already happened in the past. Implied volatility, this one is more related to the options market, okay? And it's really people, I'll say this in the most simplest form. It's simply people guessing what will happen 30 days into the future. And they use it off of a chart called VIX. This is the ticker symbol that they judge it off of. I'm not gonna get into all of the technicals behind it because, to be honest, it's boring. It's not what this video is for. But just to give you an overview of the first pieces that I learned about in this program, it was realized volatility and implied volatility. Big finance terms. Okay, so here's the second one. This is what I'll call the main trading course. And this has 4 big fundamental pieces to it. The first piece is the fundamentals behind just trading in general. And by its very definition, this is the most important part. The second part is related to timing. You may have heard about this if you've looked up any type of trading video on the internet ever. It's mainly referring to technical analysis, which honestly is about 20% of the entire process. Most people who trade online make this their entire process, but it's a much smaller piece. Number 3 is the trade structure. This is going to be things like catalyst and options if you're going to use those. And number 4 is related to risk management. This is going to be real money that you're actually trading in a portfolio. So I'll quickly go over the fundamentals because this includes essentially your meat and potatoes for an entire trade idea. If you get this wrong, you're going to lose a lot of money. If you get it right, you could also make a lot of money. But there's a lot of pieces, so let me list them off here. So first is going to be our quantitative metrics. You can just think of these as the numbers, and then later we'll look at our qualitative metrics, which you can think of as the story. So most of the quantitative metrics start with a macroeconomic view. Full transparency, I studied finance for my undergrad degree, and what I learned in this course actually taught me a lot more about economics than school even did, and I was actually pretty surprised by it. So when it comes to macroeconomics, these are all the things that they have you look for to understand what's going on in the world, and that will help you decide if you're going to go buy stocks or sell them short. So this is mainly focusing on the US because we're trading in the US. So we're gonna look at GDP, we're gonna look at interest rates, we understood bonds, they talked about M2 money supply, why that matters. We're looking at things like an ISM manufacturing and non-manufacturing survey. This is like one of the most important key pieces that I remember taking away from it. It's essentially surveys to hundreds of companies and management, asking them on the ground floor, what do your supply chains look like? And that'll give you a good sense of, is the economy starting to head in the right direction or the wrong direction? A sentiment survey from the University of Michigan. They've been doing this a very long time. Definitely flaws to this, but it's one that they use. Building permits gives you an idea of what's going on in the real estate world and how many people are actually building new homes and new buildings, hence the name. And they talk about one of the biggest pieces of the economy as a whole, which is small businesses. They show commodity prices, European sentiment. China's obviously the second biggest economy in the world, so it's important to look at their manufacturing data as well. That stuff alone took up probably 10 to 15 hours of this entire course. Like, there was so much packed into all of these metrics that I genuinely enjoyed learning about, but that's not all that matters. So let's take a look at some of the qualitative metrics to add to your trade idea. So when I say qualitative, this is really down at the stock level. So once you've already found a stock that you're going to trade, these are important to understand what's going on with that specific company, not necessarily the macroeconomic environment. Sorry for some of the big words. So one of the best places to find out what's happening with a company is on their investor relations website. And I'll actually show you. So for example, if you Google investor relations Tesla, you'll find that this is their investor relations website. This is where you can look at things like everything for 2025. You can look at what happened in each quarter. They have a press release. They have some downloads for the slide decks that they shared. And then more importantly, you can look at their quarterly reports, and that's where you get a ton of information about everything that's going on with a company. So that's going to be called the 10Q, 10 quarterly. And maybe you just want to read it annually. The 10K is the annual report. This one is packed. It's like 150 pages usually. So that's the investor relations piece. Next, you can find KPIs. This comes from all of the stuff that I just showed you, the press releases, the earnings calls, the slide decks, the annual and quarterly reports. KPI stands for key performance indicator. These are specific metrics to that company itself or the industry as a whole. So if you're selling cars like Tesla, there's going to be some standard metrics that you want to track that you can compare to other car companies. Earnings call transcripts. These are great to hear what's going on in the minds of leaders. You could argue that they're not always honest in those, but either way, that's a good place to start. Then you want to understand the management track record. Who are the people leading the company? Have they done things successfully in the past? And is there a good chance that they're going to continue to do so in the future? Insider ownership. This is how many people, usually the management, how many of them actually own the stock itself. It's a really good indicator that if people who are running the company are buying more of that stock, they're probably very optimistic about what's going to happen into the future. And then finally, analyst estimates. These are where you get a lot of your projections from that we'll look at a little bit later. So now that we've checked off the fundamentals piece, we're going to move on to timing. This is related to technical analysis, so let me explain that quickly. So timing is specifically referring to when are you going to actually put on a trade. Once you already have an idea of where the economy is going, once you know what stock you're going to trade, and you have the trade structure and everything set up, when do you buy, when do you sell? It's actually one of the hardest decisions to make. And so you can use two things to help you. I'm sure you've seen something like this a million times before where somebody gets a chart and they show some type of line and they go, oh, once it passes this here, that means you should buy because it's going to go up. The reason this is such a small part of your trade is because there's so many flaws with this logic here and with examples that you've probably seen already. And if you don't have the fundamentals of what the economy might do and what a certain company might do, all of this is not really going to help you because a stock can go completely against you and you have no idea why. Now, the second piece in terms of timing is going to be related to price action. Similar to technical analysis, this is related to looking at a chart, looking at a few different metrics, and then deciding when you're going to buy or sell. So a few things that you can look at are things like RSI. This is the relative strength index. You can look at moving averages. You can look at something like the MACD, and there's a few others, but I'm not really going to go further than that because I don't think you need it. Now let's move on to the actual trade idea itself and how you go to set that up. So once you've looked at all of the macroeconomic data and you know if you want to go long or short, meaning you want to buy because the stock will go up, or you want to short sell it because you think it's going to go down. Now we need to find the actual stock to pick. So here's one of the charts that they use that I really liked. It's a little bit blurry, so forgive me, but it basically starts with the macroeconomic data first, and then you decide which way you want to go. So if you think that the market is going to go up in the next, 20 to 60 trading days, which is the next 1 to 3 months, so we'll want to head this direction, and then we'll go to the sectors that are growing faster than the other ones. Now this is an oversimplification, but really this is just to help you get a picture of where are the best stocks and where are the worst stocks. So we're not just picking any stock that we think is going to kind of go up or kind of go down. We want the market to go up, we want the best sectors that are growing, and then we want these stocks within that sector that show the most growth. And we use a bunch of different metrics to learn this. So the first one is going to be the PE ratio. This is the price to earnings ratio, very popular in the entire world of investing. This is basically the gold standard for saying if a company is a little bit too expensive or even cheap. Hence the name. If their price is really high compared to how much money they make, probably an expensive company. And similarly, if their price is low, but they're earning tons of money, they're going to look really cheap. The second one is the forward earnings per share. Now, to keep this very simple, this is basically analysts guessing how much money a company will make in the next few years. And one of the ways they do that is with a discounted cash flow model. So just know that forward EPS is basically people guessing and doing some financial projections. And the third one is the PEG ratio. This is PE growth. That's what that stands for. Basically saying how fast is the PE ratio growing. So once you find the companies that have the most favorable metrics here, you can move on to their financial statements. So this is going to be the income statement, balance sheet, and the cash flow statement. These are kind of the big three that you learn if you take any type of intro to accounting class, which I remember from my degree, and it was, well, let's just say it was boring as hell. Now, if you don't know where to find these, I'll give you a couple. There's a few free websites that I really like to use. Again, not sponsored. These are genuinely ones that I think are interesting or at least helpful. So koifin.com is one of them. What's the other one? It's fiscal.ai, used to be finchat.ai, and the last one is finviz.com. So all three of these are free. I think they have also paid upgrades, but these ones you can easily look up pretty much any company, and then you can look at the financial statements once you have a stock that you want to start trading. So quick recap, we've gone through the fundamentals, we've gone through the timing, that's the technical analysis piece. I just showed you the structure. Options, they get very, very complicated, so I'm not exactly going to get into those, but that's part of the structure piece. Then we'll move on to risk management. I'll talk about the three main takeaways that I've learned from this, and then of course I'll show you how much money I've made so far. So real quick, risk management. I'll show you a cool chart that I think can help illustrate this. Let's move it about there. That looks good. A little bit too big. That's what she said. Okay, so this is probably the simplest chart that I could find in terms of risk management. Basically, in terms of trading, you want between 8 and 12 stocks, because if you only have one stock that you're trading, your risk is about as high as it can get because you're reliant on one single company. By the time you get to around 8 and 12 stocks, that curve is really starting to flatten out, and you can just read this as basically risk. So the more stocks that you have in your portfolio, the more your risk is decreasing. This is the fundamentals of diversification, and that's exactly what Investopedia is calling out here. Risk is eliminated by diversification. So in terms of trading specifically, and you have in your trading portfolio, 8 to 12 is kind of the sweet spot. And then I won't bore you with all the other stuff they added. Like they talked about trading psychology. There's more things around risk management. They showed you how to track all your trades with data. And then one of the hardest pieces is that they recommend starting with $25,000. So you have enough money to spread between 8 and 12 different trades. I have this little guy here. That's a lot of money, to be honest. I started it with $15,000. Later, I added a little bit more to try to get closer to their $25,000 mark. But it took me a couple years to save up this money. So I would say, honestly, that's one of the downsides, is that you just, and this isn't the day trading rule, by the way. That's just purely enough to cover the trading structures and the strategies that they use. So it's a lot of money. Real quick, I'll summarize what I've learned in my top 3 takeaways. So number 1, I learned about macroeconomics way better than I did in my degree in finance. And it's even better because it was very specific to trading and setting up this entire thing. So I thought that was really helpful. I thought it was really interesting. The only downside to economics is, I can't remember who exactly said it, but they said something like, if you spend 15 minutes a year on economics, you've wasted 12 minutes, which is kind of a cheeky way of saying economics just in general, a waste of time. So do with that what you will. My second biggest lesson, which is kind of like a broader lesson, it was really just the trade idea generation process as a whole is massive. It takes a long time. One of the things they recommend is to spend between 10 and 20 hours a week generating really 2 trade ideas. And most of the time you might act on one, maybe even not. So it was incredibly in depth. I actually found it very, very valuable if this stuff works at all, which I'll show you in a second. But at the same time, it's way more than I ever expected. It was a ton of material, and it was hard even just to condense it down to this video. And then lastly, which I didn't really go over, but it's understanding options at a much deeper level. The third piece in this entire course was an option specific course, and it was like 30 hours long, 1 hour each of different option strategies and how you can use that to, structure your trades. So I very much know a lot about how they're working. I'm sure there's still tons that I'm missing, but it's way more than I knew before. Okay, so now that we got that out of the way, let's move over to how much I have actually made over the course of about 2 years. So I logged into my brokerage account. I used Charles Schwab for this whole thing, and I got a couple different charts that I think you'll find interesting. So this one's kind of funny. This is the risk versus return profile of my trading account versus what they generally call aggressive, all the way down to the least aggressive that you can. And so if you'll see, the more you go to the right on this chart, the riskier your portfolio is, and the higher you go up, the more returns you make, the more money you make. So ideally, you want to be at the far left as high as you possibly can. This is like most perfect portfolio that doesn't exist. 7 is like you're buying, 3-month treasury bills from the US. Number 1 is what they're considering very, very aggressive. This is almost completely stocks. And then you'll see mine way out here. I'm making less returns than their most aggressive portfolio, and I'm more than twice as risky. You'll see my risk is 21.73, their risk is 10.3. So that should tell you right there that trading in and of itself is very, very risky, especially if you do it with options, which I'll show you in a sec. So here's my portfolio versus the benchmark, the gold standard S&P 500 index. And as you can see, for a while there, I was actually doing quite a bit better than it. until the stock market as a whole had a huge pullback, and I made a ton of mistakes and lost I think I was down like 20 grand in a couple of days. Yeah, so I plummeted and I have yet to come back up to the S&P 500, whereas if I had just bought and held, I'd be up a lot more than I am right now. Lesson learned. Okay, here's the coolest chart. All of these green bubbles on here are trades that I won, and these red bubbles are trades that I lost. It might go without saying, the bigger the bubble, the greater the magnitude of it. So a really big red bubble means I lost a lot of money. Here I lost like $600, $700 on a single stock. The rest of these are a couple little $50, $100, couple $100 wins. And as you can see, my total gains were 22,000. This is purely from trades, but my total losses were also 18,000, almost 19 grand. So really I'm only up $3,600 on a portfolio that is at a total value of 50 grand. And if you do the math, that is far less than just the average 10% that the stock market returns. So in total, my entire account, I initially started with 15,000 like I mentioned earlier. I've since added 23,000. That's kind of these two jumps here where I'm adding money. And I've made a total of $11,402 over the course of about 2 years. Now that might sound really cool, right? At least I made some money and didn't lose my entire portfolio. But you can see I already showed you this part of the chart a few minutes earlier, but this is where I made a huge mistake. I lost money and I've trailed the S&P 500 ever since. I am now back in the green. I'm sitting around $50,000, but most of this money did not come from trading. And that is the number one lesson that I've learned from this entire thing. I made about $3,600 from trading in and out of options, making my portfolio incredibly risky, earning less than the S&P 500, went through a lot of stress, seeing 20 grand drop in a single day. And I wouldn't say wasted 2 years, but I spent a lot of time over the course of 2 years on something that could have earned more if I had just bought an index fund and just held. So that's what I'm considering my number 4 bonus lesson, biggest takeaway from this entire thing. If you are thinking about trading, if you're thinking about buying a course, spending a bunch of money, spending years learning how to do it, you have to be willing to take the risk that you might be wrong, you might suck at it, and everybody else who just buys index funds and holds is more than likely going to beat you. So as long as you're okay with that, maybe give it a shot. But if you're curious about how I actually built most of my wealth outside of this trading portfolio, check out this video next, and I'll see you there. Done.